20 minutes pitch. If you have like short questions, you can ask it. But if there are like some questions that you can want to solve, wait a little bit because after the two pitches we will have Q&A here and we can talk about all the questions that we received today from production.
Well, good evening. So I'm going to talk a little bit about some experiences, and I'll try to relate the experiences and some principles that I kind of pulled out and relate it to my experiences around a company that I started, co-founded, called BroadSoft. And I picked a few principles that I wanted to share and you guys some questions. So let me first, if you don't know who BroadSoft is, it's probably on purpose. We started the company in '98, and we were one of the first companies in what eventually was called unified communication space. So if you're sitting on a Zoom call today or a Teams call, well, we were there a long time before them, but we were not an end user brand, we were an industrial brand. Talk a little bit about how we went to market. But in '98, it was quite, I'm sure as founders, as you guys know, when you go out with a disruptive idea, you want to talk to customers or partners, and first you would say, well, that's a really stupid idea, and kind of think through that. So I always respect early stage entrepreneurs that went out. And what we did is we went out and said, the world at that time was full of hardware solutions, hardware-based solutions, and we believe in open standards and software, and so we built a business around that. And we started in '98 and built a company, and I'll talk a little bit about some of that experiences. But in 2010, we took the company public on NASDAQ, and at that time, the IPO range was about $100 million. Right? 98, 2010, and as you can imagine, the first few years there was zero revenue. So 100 million is like a really big number, and it was a very big number. And then we ran the company as a public company for 8 years. I don't advise it. I think Gordon would talk about, after that I never wanted a full-time job. Running a public company, delivering quarter after quarter is quite stressful. And talk about sales, and you got to deliver on your numbers, and your stock goes away. And as an entrepreneur and on exit, when most of your personal liquidity is in one stock, you work 80 hours a week to make sure that you keep it. And in 2018, we then sold the company to Cisco. At that time, we were about a $500 million now. So 100 million, 500 million. Different stage of business, different type of scale. And the interesting thing is, through the 20 years that we ran the business, we also acquired 25 startups. So we not only built the company, we also had lots of young entrepreneurs join our company. We landed up with employees in 23 countries and served customers in another country. And then I did, as I say, I did my 2 years of my tour of duty at Cisco, or my jail time. And that's 25 years of not having a boss. When you wake up in the morning, you have a boss. It's not fun. And so in 2020, I left, and we started a few of us, a few of the management team at BroadSoft. We started an advisory business and company scaling, market strategy, positioning, some M&A. We're not bankers, exit. And thinking about what entrepreneurs really want. So a lot of times I have to advise entrepreneurs, okay, what do you really want to get out of this? And what's the goal? So that's kind of history. So some of the lessons I'll share, I'll try to relate back to the process. So the first thing is, the presentation is kind of talks about, kind of IPO is kind of destination, and I say start with the end in mind. And the reality is really a bad idea because you don't really want to start with the end. And exiting is an event. It's not company building. So usually what I say is, make sure that you have built the company, built the business, and bet on things that are foundational, transformational. Typically what happens is lots of people have little ideas. There's a lot of startups with little ideas. They're hard to move along. Things kind of disappear. So if you're going to start something, you're going to bet on something, bet on a market or a technological transformation where that is big. You got to make a big bet, and especially if you're going to eventually get to an IPO. That's a great. You've got a pretty big market opportunity. Public markets are pretty tough. If you're starting something and your goal is to kind of maybe do a small tuck-in, then you can really take the small companies. And we had a belief that software was going to keep the hardware, and that we thought that was kind of the bet we made. We made a bet on open standards. A lot of companies at the time were very proprietary hardware. But it was the way that everybody consumed telephony, phone systems, meetings, a lot of custom hardware or dedicated hardware. And when we went out and talked to companies and said, "Oh, we were going to put this thing in the cloud," in 1998, no one knew what the cloud was. I said, "Well, we have this perfectly good box here. What are you talking about?" So you get a lot of negative feedback. And so I'm sure you guys see that. You go home at night and kind of go, "Okay. I still have a good idea. I got to fight through these things." So really, the message is, don't think about an IPO or an exit when you start. That's a really bad way. I think we really want to think about it as, how do I build a business? How do I solve real customer problems? How do I build something that's value? And then think about as you get a little bit down the road, think about how you might exit. One of the most important things that, and I spent a lot of time with that today in businesses that I advise, is really thinking about, I kind of say, like, if I think back in '98, building a very large software system, probably the number of lines of code that we landed up in our product was millions and millions of lines of code. It was a very big software system. And it was hard to build, and it was complicated to build. We were replacing very large telecommunications switching gear that filled rooms, and we were now delivering software with the same, people are familiar with things like 5 nines reliability, which is downtime committed a year, very small amount of downtime, large events, be able to kind of take huge traffic volumes and be able to recover quickly. All of these things were really, really not achievable in software at the time. And so you have to kind of invest quite a bit of money in engineering and development. And that was really the focus of the business in the beginning, and then eventually obviously shifted to the sales and marketing. Today I would say that a lot of the companies I work with, building the product is not as hard as it was back then. Actually, sales and marketing is so much harder. Getting attention of customers, I don't know if you guys look, you go see a CIO today, and he's got like 50 startups out the door, and you're trying to get 5 minutes to kind of get your message. Really, really difficult. So building a scalable go-to-market model, really thinking through how you're going to sell the product is fundamentally important. And being able to demonstrate, we'll talk about, I think Gordon's going to talk about M&A transactions, but raising money. Investors want to see that you got product market fit, and that you now have the ability to kind of execute growth in the pipeline, procure customers, grow those customers. Two things we did, again, it may not always be applicable, just understand the ecosystem you live in. And what we decided to do, and that's why I talked about BroadSoft, what I call an industrial brand, we decided to basically deliver our solution through the biggest telecommunications companies in the world. So Verizon, AT&T, British Telecom, Deutsche Telekom. We had them all. Okay, so we were like de facto standard world, but they would brand it with their brand. So we never had to do the end user selling, the end user listing. We had to obviously sell into Verizon and sell it to AT&T, T-Mobile, etc. around the world. And these are not easy customers to get into. And so that was a marketing product, a marketing business decision that we made to not have that huge sales cost to try to go and close every single enterprise customer, but actually distribute through those companies. And back to the first time we went to Verizon and said, oh, we got this product. The head of network said, oh, here's our two telecommunications vendors, which now no longer exist. And I said, look, I understand two vendors, we buy all your stuff from them, hundreds of millions of dollars, but this is all I got. So I'm going to be back tomorrow and the day after. I said, I'm like the sales cockroach. I'm going to be here every day, and I'm never going away. And then eventually, And one way we actually broke in, again, it's a thought, is we started with something that was pretty out of the mainstream, and we created kind of a very close partnership on a new product that they didn't have existing vendors for, and that allowed us to have a pilot scenario with them. That never really took off into a big way, but it built relationships, built trust, built competency, etc. So those are two things that we use. So we call it partner-centric model. There's a lot of channels out there. So I would say that one of my advice is understand how you're going to sell it. Is it going to be direct? Is it going to be channel? Is it going to be partners? Who's in the ecosystem? Which companies, when you sell your product, they sell stuff, they make money, because then you want to figure out how you kind of play through those partnership models. Try to do things on your own in the beginning is pretty hard. So you want to figure out, one of the things that we did is when we sold our software, there was a huge ecosystem of hardware. For example, there was a server company called Sun Microsystems and we actually sold huge amounts of Sun Microsystem hardware, and so that was a really good. So we used Sun as a partner to help us drive sales. As you're kind of scaling, is obviously not that important as a startup because you have it. As you start growing the business, you have to start thinking about people, culture, and governance. Like when I started this with the business, I never thought we'd have over 2,000 employees, 23 countries. And I have to tell you, that's a hard thing to manage. Like HR madness. Every day there's kind of HR crazy. And so you want to make sure that you think about how do you make sure that everybody within the company, has the right mindset. Don't be afraid to kind of fire people. And make sure you build a culture of accountability. It's really important. Make sure everybody is honest, transparent, and a focus on execution. So those are some of the things I would say. And I think a lot of startups do this, and I see companies that don't do this sometimes, but really have kind of an owner mindset of employees, so equity mindset. Everybody, in our case, everybody got equity. Everybody actually did fairly well. It's actually one of the good things about when we finally went public. Employees who could pay their mortgage down. That felt really good. And the other thing I would say is don't forget about as you start to build a business and you start getting into that sales and marketing world. Also think about early governance because it's really important. I'm sure Corey will tell you. We bought 25 companies, and every one of those companies it was a disaster buying. Right? But the minute you say, okay, show us all your contracts, they say contracts. Somewhere, and so having good financials, like one of the death nails is when you're trying to raise money or sell, and you present some financials and there's mistakes in there, or you make a mistake on forecasting or whatever, you lose a lot of confidence. So early governance is really important, and I think one of the things that we were very fortunate of, and we don't. Sometimes I hear entrepreneurs kind of wonder if that's valuable or not. Recruiting a really quality board, advisory board, or board of directors is really important. And make sure you find the right people and you give them real stuff to do. And so that's really important. They can't help, especially folks like myself who don't want to. Like Gordon and I don't want to. I think it's really important to think about when you're starting to, as you start to kind of build a business and that, you want to start really growing the sales side of it. My personal thought is you really need to let the sales organization, a trusted sales organization, that's all trusted sales organization, but the sales organization, the customers really need your plan, right? To be honest, I'm not a really big believer in people call product-led sales. You know, like that, it happens once in a while, but I have to tell you, most things have to be sold. Okay, there's very few things in the tech world that people just buy. Okay, it does happen, and there are all these case studies and good examples. But I'm a firm believer that technology is sold, and you need to be able to explain how it's going to be used. Use case selling as a big factor, and then also creating inside the organization the ability for a very strong set of accountability. One thing we did early days, all the way to selling the business, we did kind of, it sounds kind of funny, we did an annual strategy review, but the idea was that we brought in the beginning, most of the team, later on, smaller parts of the team, maybe 2,000 people. But we might have 40 or 50 of the most senior people in the organization, and we would rip the business down in 3 days. We would kind of look at what we were doing well, what we weren't doing well. We'd look at the public market, private market. We'd look at customer feedback. We'd look at everything and kind of rebuild the business for the next following year. But very, very focused on top strategic focus areas. Never down to like, personally, I'm not a micromanager, and so I like to have, you know, this theory of the top 5. And so saying, here's the top 5 objectives for the next year, and then you, engineering, sales, marketing, whatever, you now have to figure out what do you need to do to execute on those top 5 strategies. So that's one of the tricks that we use very effectively. So I really ripped it down, bring in external speakers, and really kind of honestly listen to the team and kind of rebuild the strategy. In some years, you know, out of the 5 that we came in with, we might exit with 3 of the same or 4 of the same, and sometimes it was just completely gone, completely changed. And still same business, but we had different priorities, different focus areas. And you know, I used to say, you know, ideas are cheap, execution is hard. You know, so people will come in every day to my office. Oh, we have a new idea. I'm like, okay, we're a huge business, and execution is hard. So how are we going to execute these ideas? So you know, think about the execution factor, and execution it does come down to a level of set of detail and how to manage. So that's really important. And then this is especially important as you start to think about either a transaction or especially an IPO. The ability to communicate the value proposition, the market story, the compellingness of what you're doing is really, really important. And think about it, like this took a lot of cycles, because like when you're usually in your day-to-day, you're talking to someone, especially in the tech world, you're talking to someone who has some technical ability, they understand the problem. Now you're going to invest in it, okay? And a public investor, honestly, may have, the hour before, they may have had a pitch about a concrete company, and you're coming in with some crazy tech. And they're like, they don't know anything about your business, and you're trying to sell $10 million of shares in 30 minutes. And you need to be able to explain your business in, like, the bankers will tell you, grade 8, English language. It's got to be really simple, to not be complicated, and you need to make it compelling. You need to show why you created a differentiating capability, what's the market, what's the moat you created around your business. And those moats don't have to always be technical. They can be, I just had a conversation this week with a customer of mine, and we talked about partnerships and ecosystem as an important moat, right? You know, we're kind of building a very open system with lots of partners that can come in, and that's a real differentiating that other companies that are trying to do not being so open. And so you can have a variety of different ways of creating that differentiation, but it's really important to have that defensible and clear differentiation. And then also, one of the challenges is not try to do too much, but also describe how one vertical well and tell bankers or investors, hey, here's the next two growth vectors, two growth levers. Sometimes the growth levers are international. Okay? So we went from a U.S. company to a global company. Sometimes it's different market segments, different verticals, different use cases. But focus on one where you can really knock it out of the park, get it done, and grow it. But getting a company public, a certain bar of execution, certain revenue, being able to prove you've got a repeatable, as I mentioned before, repeatable sales model. Okay, you can basically deliver. Bankers will not take you public if they don't think you can. I mean, you don't want to go public if you can't deliver the next quarter revenue on target the quarter after, because if you go out at X dollars per share, then the next quarter you'll be down kind of penny and you'll never come back. So I think that's just kind of the competitive and market story, especially going public. But I think it's pretty similar, a little more demanding when you're going public because your investor community will be not technical, they'll be financial investors. And when you're raising money, usually the venture community, you'll normally talk to folks that have, they've got some knowledge in their vertical, right? Whereas you deal with investors, even the bankers they're transaction folks, right? They're not really technically skilled, and so you've got to really be really good at telling the story. And the other thing is you've got to be able to tell the story 10 times a day when you go on. That's the hardest part. When you're doing the same story 10 times in one day, you start to lose, like, did I say that? But yeah, you've got to be able to deliver the story. Forget about slides. You don't need slides. The slides are important to start, but and I tell you, what I learned from going public is the number one role the bankers do in these meetings with investors is they hand out the books, and then they collect the books because they're not allowed to say anything during the meeting. And so you are on your own. They just we used to call ourselves the talent. So they just bring you in, the talent goes, and then a couple hours later, the banker will say, okay, they've ordered 10 million shares of your stock. It's kind of fun, but and sometimes they no. Anyways, so that's a really important barrier, and I think but it also applies when you're raising money. The earlier days is obviously make sure you've got a very compelling, easily. It may make sense to you, but you got to make sure you do. So, anyways, that's it.
Okay, thank you, Michael.
All right.
Yeah. Sounds easy. Thank you.
It's really easy. It's only 20 years. Short journey. Only 20.
Mike. No.
All right, just go slideshow.
Yeah.
So welcome everybody to Capital Factory. For those of you that I've never met, I'm a co-founder of this crazy place. And for about the last 4 years, I've been chairman, which just means I don't stress near as much as I did during the first 8 or 9 years of this crazy place. Michael talked about the story of the path to IPO. I'm going to talk about M&A, building a company that you aspire to get acquired. I'm going to try and demystify a few things, and I want to tell you, whether you believe it or not, and even if you have no interest in being acquired for 6 or 8 or 10 more years, there are things that you could do now or should stop doing right now that could make a dramatic difference on your future acquisition exit. I know because I have sat on both sides of the table and I've written stories about it, and I'm going to tell you just a few of those things. Also wanted to mention, this is automatically moving, the slides? I didn't touch, but that's okay.
Sorry.
On my Shockwave Innovations website, I have about a dozen articles or so on acquisition. So if you find yourself getting serious about this and you don't remember anything I said, just go to my blog, select the category for M&A, and you'll see some articles. So I love quotes. One is about luck. Luck is when preparation meets opportunity. And what we're going to talk about today is some of the preparation. What is it that you can do to kind of prepare for this event that you're not even really planning to execute on? Good? Thank you. So just to demystify the process of being acquired, kind of the way it typically works, sometimes you're planning this, sometimes you're instigating, and sometimes it just comes out of the blue. You build a great company, you get some notoriety, don't be surprised if somebody comes and kind of knocks on your door. That's the courtship process. They're getting to know you. If it gets really serious, it might move to where they offer you a term sheet or a letter of intent. It's a 2 or 3 or 5 page document that outlines the high level summary of the terms to acquire your company. You negotiate that, and if it becomes acceptable, then you go into the fun part, which is due diligence, where they basically get access to everything, like literally everything. It takes quite a while. It's very disruptive, and if you're fortunate, you'll sign this thing called a merger agreement, and you'll put rings on each other's fingers and live happily ever after. So this is kind of the process. I wanted to say this because this courtship process can kind of throw you off if you've never been into it. There's a lot of what I call sniffing around. That's why I've got the dog there. Don't get excited just because someone from my company or I come talk to you and getting to know your company and maybe says the word acquisition. Number one thing to not do is don't go open up the spreadsheet that shows how many shares you have and how much ownership of the company you have, and you multiply that times 100 or $500 million. Because if every one of you right now were to tell me that, God, it's crazy that you say that, Gordon, literally just yesterday, I met with somebody and they said, like, hey, we could have some interest in maybe an acquisition. Would you be open to that? If that happened to every one of you, I would bet every one of you $100 that no deal gets done. And the reason I would do that is I'm going to make money off of 9 out of 10 of you, probably, right? And I also say this because I was that guy. There was a period of time where my little 150 employee company decided to get aggressive on some acquisitions. There was a reason for that, and I was the one that the CEO said, hey, go out and talk to them, and go talk to them, and go talk to them. And over about a 6 or 7 year period, I probably talked to 30 companies. We did 4 acquisitions, okay? Next thing to think about, if you're approached, are they buying your company or are you selling the company? I know it takes 2 parties to get a deal done, but if you had to really say, are they buying or are you selling? Which is it? Because the answer to that question dramatically influences the negotiating power you do or don't have. If you are desperate to sell the company because you're running out of cash and you cannot raise another penny, you're a seller. And if you're a seller, you can fake it a little bit at the beginning, but you can't really fake it. Because remember, after you sign the term sheet, they get to ask you everything. One of the first questions might be, show me your bank account balance. Oh, shit, you only have like $2.86 in the bank? Okay. But the reason I say this is, like, it's not just seller, buyer. It's a continuum, right? On one end, on the right is where you love to be. Your prospective acquirer desperately needs, they must have what you have. It's a massive difference maker to them. That would be on the far right. On the far left is that fire sale. Your nose is down and you're going to crash into the ground very soon, and you have to sell the company to maybe extract some value. But then there's others in between. So I'm really just recommending, look yourself in the mirror. Where are you? There are ways that we try to fake this a little bit, but you have to understand where you really are. And if you're over on the right side, you do have some leverage. I've been fortunate to be on the right side. I've been unfortunate to be on the left side. And when I was on the right side, believe me, even though it was a Fortune 500 acquirer, we got the terms we wanted, and we just said no. And they didn't understand. They'd never been told no before. And we're like, look, we're not selling the company, you're buying it. We don't need, like, we're happy to continue building a great company. If you really, really want it, then tell your lawyers they're just being idiots and we don't need to agree with what they're saying just because they're lawyers for a Fortune 500 company. But that was my language over here on the right side. I can't use that language if I'm on the left side. When you approach for acquisition, if you are, my recommendation, unless you're on the far left side, if you're fire sale desperate, it's one thing. But if you're anywhere in the middle, don't immediately get excited in front of this acquirer that you want to sell the company. My recommendation would be to say, if they say, hey, so what would be a price that we could buy your company? I'd say something like this. I'd actually even say, like, hey, look, we hadn't even thought about selling the company until you brought it up, so I don't even have a price. Our mission is to build a great company. Well, I know, but like, what's the price? And I would resist that. Like, your mission is to keep building a great company until they knock you off of that strategy. These are the words that companies use when they're not selling the company. They're maybe allowing themselves to be bought. Do you understand the subtle difference? It's like crazy important, because I have a nose for this. So when I'm meeting with you, I'm first trying to figure out, are you a seller? And you went to Gordon's lecture and you're using this, so I'll kind of poke and prod. In the courtship phase and before you have a signed letter of intent, your prospective acquirer is entitled to some information. I mean, for God's sakes, on these 2 or 3 pages, they need to put a price tag and maybe how much of it is cash and how much of it is stock, and how many of the employees will they retain, and there's let's just believe me, there's half a dozen or a dozen important things that are in there, and if I want to acquire your company, I can't just do that blindly. I need some information from you. But as an acquirer, I'm going to ask you for a lot more than I really need just for the basic term sheet. I'm going to ask you for as much as you will give me. And I'm really good at this. So I know how to ask for some basic things and then ask for just a little more, the next level of detail. And then and now that we're there, a little bit more. One of the ways I can tell you're a seller is if you keep giving me more information before I've ever presented you with a letter of intent to acquire your company. So if I'm on your side, what I want to ask myself, every time this acquirer asks me for a piece of information, I'm asking myself, do they need this information in order to present a term sheet, a letter of intent? Or is this information, of course, they need before we're going to sign the document where we put rings on each other's finger? Which category is it? Okay? There's a little bit of gray area, but just this is an example. In my opinion, it's probably okay to share with them a high-level sales pipeline, because they want to know, they're going to want to know, show me your revenue for the last year. Yeah, of course, right? They're going to get high-level financials. How else would they give you an offer? But they might ask about the pipeline, and you guys are the sales team and the sales and rev ops, right? So you have a lot of detail. They don't get all the detail. They might get a high-level pipeline aggregated by stage. They don't get to see a list of all the opportunities and where they are and the dollar amounts. And no. That comes later. Maybe they get to see some high-level revenue and profit trending. They don't get to dive in to understand within your marketing budget, how much are you spending on advertising versus SEO versus whatever. That can come later. They don't need that on the right side in order to make a high-level offer. On the product side, yeah, they deserve a demo, but you give them the same demo you would give somebody at a trade show. Maybe a little bit more. Maybe you tell them a couple things that you're working on that you're going to release in the next month or 2 or 3. They don't get to see your 2-year roadmap in detail, and they certainly don't get to crack open and look at your source code. So you see the big difference here? The stuff on the left they need to give you a letter of intent to acquire. The stuff on the right and a long list of other things are what they need during due diligence before you sign the merger agreement. 185 rows of requests. Yeah. Okay, how about how much you're worth? What is your exit valuation? this is kind of a trick. It's part art and it's part science, but one thing I want you to understand is it should have more to do with what your acquirer could do with you, your team, your product, if they owned it, versus what you've been able to do, most likely with extremely limited resources. It's possible that you'll build a great company like Michael did. Many of you will not reach that point before you're faced with a potential to exit, and probably you were resource constrained at certain points along the way. And so I just want you to understand that we don't just take your historical revenue and multiply it by 5 or 8 or 10 and that's the right price. You know how I know this? The Fortune 500 I was acquired into, they didn't know what job they wanted for me for a while, so they put me on an acquisition deal team. And one of the deals that I did, the company was about a 20 employee company, almost all software engineers. They had about $1 million in revenue. And we paid $100 million for them. Number one, it was a competitive deal. What they were working on was pretty hot, so there were other acquirers. So it was a competitive marketplace. Otherwise, I'd have bought them for 10 if we could. Well, they probably would have said, no, get lost. We'll just keep building a great company and you'll pay 100 for us later. But the reality is, as we ran the models, I was inside of a Fortune 500 now. We had 13,000 employees. I think like 3,000 of them were enterprise sales reps. These are elephant hunting deal machines. Take this product, add it into their sales bag, let them go sell it. Like, we knew we would sell like $30 million of it in the first year and $150 million in the second year, and I don't know how much. So we were able to justify a $100 million price tag because of what we would have been able to do with their product, not what they had been able to do with limited resources. Does that make sense?
What was the product?
Sorry?
What was the product?
It was in the network management or application systems, IT systems management industry. But there was another one earlier this year. I helped one of our portfolio companies get acquired. They were about $1 million in revenue. I can't tell you the price tag because if you might find out who the company was or whatever, but they got acquired for well north of $100 million by a Fortune 500. They were doing about $1 million in revenue. It was a very strategic acquisition. It was, yeah. So if you have a good fit and if your acquirer can do amazing things with what you have, it doesn't have to just be a ton of revenue. It can match a very strategic priority they have and put them down a path or whatever. So magic can happen there. So how do you boost your exit valuation beyond just being strategic? If you have a high or very high rate of historical growth, that usually impresses your acquirer. Now, what is high or very high? Well, it depends on your stage of evolution. If you're a startup with $1 million in revenue, you don't impress your acquirer by growing revenue 30 or 40% year over year. I mean, and I'm not saying that's easy to do, but if you're only $1 million in revenue, probably growing revenue, doubling or tripling in the early years would be impressive. When you get to 10 million, okay, maybe it's harder to triple every year, but posting good growth rates, having a revenue forecast that's both exciting but also believable. How does it become believable? Because you happen to have a formulaic approach to driving revenue. This is where your sales leadership, your rev ops, your sales ops, your tools, your processes, if you have predictability of revenue growth and formulaic revenue growth, then they're going to believe your forecast. Otherwise, whatever you show, I'm just going to whack it down by like 30% because I know how forecasts go, right? But you evidence that. If you have a world-class team, especially in the functions that your acquirer cares about, if they're acquiring you because you have badass real AI, do you have a badass real AI team? I hope so. Or, yeah, the functions that they're most acquiring you for, if you have kind of world-class team, that can boost your valuation. And then anything that just, I'll say, significantly modernizes, what I really mean is like, a lot of these big companies, you think they're amazing in their technology. I'm sorry, they're not that amazing. They're way, way, way behind. You guys are at the tip of the spear. And they want to be at the tip of the spear. It's just they can't move that fast. So, you know, if you modernize them in certain ways, they can get really excited about that. And that can boost your price tag. And I think one of the last things I'll say now is, even after you sign the term sheet, you might think the deal's done. No, I got the Fortune 500. They signed the term sheet. It's $185 million, done deal. They just need to check a bunch of stuff. No, it's more than they just need to check a bunch of stuff. Like, the terms can change. And they can change because they see things they don't like. And guess what? They're going to find things they don't like. Guaranteed. The best of businesses, they will find things they don't like. And they will use that against you, for sure. It's still kind of a negotiation. So if you can impress them during the due diligence as they're poking and prodding and opening every folder and everything, if you can impress them, you will have some leverage to offset the things that they don't like. Okay? I've been in this movie. I was in a company that was amazingly run. We blew our acquirer's mind how mature we were. How when they sent us that list of 435 line items, and we looked at it, we got as a team, like, okay, check. We looked at about 20 or 30 or 50 of them. We had tens of thousands of pages in their data room within 48 hours, and they couldn't believe it. Within a week, we had 100,000 pages. We're like, wow, how did y'all do that? See, we were impressing them. And so when you have sophisticated systems and tools and the well-oiled processes that go around that, believe me, they notice that in due diligence. Like, wow, these guys are running an amazing ship over here. Versus, you heard Michael say, dumpster fires. I mean, there's lots of startups that are just in total chaos. If you have a deep understanding of things like unit economics and how it all works, this is just like the formulaic aspect of your business, and you demonstrating to them, you will impress them. If you can predict the future with reasonable accuracy, the due diligence process can take 2 or 3 months. So you telling them what you're going to do in 3 weeks, and then 6 weeks, and then 8 weeks, and you doing that, it blows their mind, right? And then, of course, we're in the age of AI, so I kind of have to say it, but like, are you really using it to gain unbelievable, actionable insights for your company? Because don't assume that the big companies are using AI the way you know how to use it. You're growing up on it. They wish they were like you. So you showing them what it really means to be, for those of you that happen to be AI companies, what it really means to be a native AI company, I think you can impress them during the due diligence phase to go ahead and get the real deal that you wanted, or actually make it even better than what the letter of intent said. This was my case. We got a better deal than the letter of intent because of how much we impressed them. Hope that was interesting and insightful. I think now we're going to bring Michael up and see, hopefully you desperately want to ask us a bunch of questions.
I was gonna add a comment to something you said. No, I probably don't either. What Gordon said, which was really interesting. I think I like the was it the pursuit or when they approach you, right?
Yeah.
One thing I suggest, I think you kind of said it, but I just want, because I was in a call today with a client and a banker and stuff, is which is, it's hard to break the tendency. It's like someone comes and says they want to buy your company or whatever, and you're like, oh, I'm selling. I'm kind of in that sales mode, right? Actually asking a lot of questions of potential acquirer so that you understand their potential synergies that Gordon mentioned. You may not understand that well enough. You may not understand their business enough. And if you can go back and say, oh, look, you can sell $100 million because you have 3,000 salespeople and whatever, and you have these list of, call them synergies or opportunities, then you're going to help them justify their internal business case. But it requires you to stop answering questions and ask some questions of someone who comes to see you and says, hey, we're interested in your business. Okay, how do you see it fitting in? What do you think the synergies are? Like, ask questions. Like, don't just answer. But our natural tendency is we want to answer the questions that we're asked. So, but I like the way you laid it out.
Yeah, if we like ask the question, it's the right time to ask your question.
Yeah.
I will call with microphone.
Sure.
Okay. Hi. Now that you have the experience of both being on the startups seller or being acquiree side as well as being the acquirer side, what questions should you have asked during due diligence?
As the acquirer?
Mm-hmm.
What questions to ask during due diligence? God, this is a hard one because it's hard because I've been through enough of it that I have my checklist. So really, I feel like I've got a good checklist, and they're out there. Like if you want to, these due diligence request lists they're not that secret. But I think actually, if I were to go do a deal right now, probably a trap I could fall in is thinking that the checklist that I last used 3 or 5 or 12 years ago is still a good checklist. And I'm not sure that's the case. And with every deal, there are some nuances. And the other trick to due diligence is to break it into phases. The first phase of due diligence to me as an acquirer is, do we still really want to do this deal? I want to kill the deal within 2 or 3 weeks. If I hate it when I discover things towards the end that become deal killers, or because man, now you're, and so I want to kill it quick. And there are certain things in the due diligence request list that are pretty fundamental, okay? And then there's a bunch of other stuff that's actually just, we got to go through, we got to ask for a copy of this and blah, 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 blah. So don't waste the target company's time on all the crap that you need to do in the last phase of due diligence. Do the first stuff so we can both kill this deal if it's not going to happen, is something I'm thinking. What
I think personally, I think that the biggest, as an acquirer, the biggest risk you have is can you really execute on the synergies that you think. Frankly, the due diligence is important, but that's you're now in the minutia of details. The ones that we did that didn't work was because we failed to understand how was it really, where could our salespeople really sell it? Did it really work? And all that stuff, which is kind of much bigger picture things than like the spreadsheet due diligence. I think that's where I found the biggest issues as an acquirer. Is like, and to be honest, if you think about acquisitions as an acquiring company, we recognize that 50% of the acquisitions would work and 50% wouldn't. It's just the nature of, they're hard. They're hard to work. No matter how much time you spend with the team, we would spend a lot of our acquisitions came out of our partner ecosystem. We had 100 partners, so we knew these folks and whatever. And even then, I would say 60, 70% worked, but 30, 40% did not achieve what we thought they would achieve. And those are usually the big assumptions at the beginning. That's my personal experience. Not so much, the super details on the way to due diligence.
Okay.
So I don't know how this question really fits exactly where this topic is, but I think it does at some point, which is this. Speed is, the ability to change things and do things is so fast now, right? So in terms of like companies you're paying attention to or thinking about, I don't mean their brand, I don't mean the actual specific companies, but more the types of companies. Where does open source fit in today versus proprietary? And obviously AI assisted development fits into this, and I'm talking about as a growth strategy also. So I just generally wanted, do y'all have any general comments on that? Because I'm seeing it all over the place and it's fascinating. I just want to know, y'all are kind of further at the end of when a company's ready to sell. So open source first, proprietary in today's world, quickly changing world.
So I definitely have opinions on open source, and then I'll make sure to talk a little bit about in the new age of AI generated code, vibe coding, etc. One of my articles is titled, "Don't Let Misuse of Open Source Kill Your Acquisition Exit." It doesn't say don't let your use of open source kill your acquisition. Don't let your misuse. What I mean is a lot of startups would think open source just means it's free. So download it, slap it in there, make a bunch of changes. Woohoo, man, like my 10,000 lines of code, 8,568 was just open source that we stitched together with another 1,300 lines of code. Congratulations. But when you get acquired, in the 435 lines of requests, there's a whole section that's probably 80 of them that is all around intellectual property. One of them is going to be worded as follows. Please share with us a list of every instance of open source in your code, and please have the following columns in your spreadsheet. What it is, where you got it, how it was licensed, and if it was licensed via one of the copyleft license types, please also tell us, did you enhance? If you enhanced, did you contribute it back to the open source community? And then there's 5 other columns in the spreadsheet that I can't remember. Many startups go, oh, crap. Like, many startups cannot even produce the list. I walked away from a deal because the company could not produce a full list. And if I had acquired their company, and if they were misusing, if they had enhanced and not contributed back, the moment I acquire the company and sell $1 of that product, it's now on me. The Open Software Foundation files a lawsuit against me. So this is the whole thing about just understand what it is, how it's licensed, take the licensing serious, because some of them are very permissive, others are not. So that's just a warning. In the new age right now of AI, I have no clue what it means to tell an LLM to rip off a few thousand lines of code that does some stuff. I think most of the lawyers right now are trying to even figure out what that means, to be honest with you.
If I could, forgive me.
And every acquirer, they know they're using open. There's not a problem. Everybody. 100%. That's not
100%. And I think I didn't. Your answer helped me realize I didn't articulate my question well. Thank you. Which is more as a startup itself, like when you're making your decisions on how.
Open source?
Yeah, it's almost for me at this point, like the way I'm thinking about it is a distribution strategy initially, not proprietary versus open source. Like they're very different paths and how you build the value around them, and that's more what I was.
It's a question
asking.
like
In today's world.
What's your value? What's your special sauce? And your special sauce might not be in writing amazing code. You pull together stuff, but you have something else that's special. So if you're 100% open source, I don't know that that's a deal killer necessarily. I wouldn't think so.
No, I mean, like I think you have to choose that path if you want to go down an open source model. It's totally different go-to-market, different business model, different revenue streams, and so on. And switching in the middle is a bit of a challenge. On Gordon's answer, you have to be super careful when you use open source. Like when we got acquired by Cisco, we had the code proctologist.
Oh my goodness.
Every line of code.
Yeah.
And thankfully, we had it all documented. But yeah, you're absolutely right. Because even though we were a big public company, I appreciate Gordon's point. We were a mild lawsuit candidate. Cisco was a super good lawsuit candidate. Right? It's a much bigger public company. And so someone would maybe not spend a ton of money chasing us, but they would spend money trying to do that. So IP and open source, you have to be buttoned up around that. There may be areas where patents are important. Patent violations could be quite patent licensing. Again, all of that stuff is quite important. And I agree. I think we're still in the early days about what does AI-generated code look like. Because if you think about anything you ask, AI model, it's stealing a piece of fragment from someone else's work, right? So it is a trademark, a bit of a trademark risky area, but I think no one's figured that out yet.
And because of it, I have a feeling that proprietary, homegrown, hand-on-keyboard written software is not going to be the reason acquirers acquire you. They're going to acquire you because you are selling into K-12 school districts, and you know exactly how school teachers and principals and administrators think. You are intimate with that customer and their use cases, not that you put your hands on the keyboard and wrote the thousands of lines that did things. Like, that's in the past.
Yeah.
That is aggressively in the past.
Yeah.
Yeah, I'm just curious on as far as levers of growth, because I know you spoke about partnerships, your ecosystem, as well as acquisitions. So I'm trying to just strategize of like which lever to pull first and, you know, the sequencing of that. Because, you know, I'm in a position where I'm thinking it's like, I don't want to deploy all these resources to build an extremely large internal sales team, and I would like to do a higher leverage type deal where I can acquire a bunch of customers just one relationship or make an acquisition. So I'm just curious of your thought process with those like levers of growth. Do you want an answer?
Yeah. Yeah, no, I think, first of all, I think your question's correct. You know, think about distribution and sales and how do you get to market. Selling's expensive. It's a very expensive function. And so you have to kind of figure out are there, and you know, everything you're doing in terms of, you know, you're either adding a new product or you're adding new markets. And new markets could be new geography. Geographies are very expensive. I mean, wow, they're crazy expensive. You know, you need to be licensed and taxes and currency. It's a huge complexity factor. And I think one of the things I learned in servicing that many markets is that you don't really know the market until you're there for a time and you understand what's happening. Like, you know, UK speaks English, kind of, but it's not really the same market. The distribution's different. The customers are different. Compliances are different. The way people buy software, you know, solutions, the level of competency and so on. There's also a lot of factors that are quite different. So I don't know if there's a generic answer to the growth, you know, which growth lever do you throw first. I think what I usually find is that in early stage, entrepreneurs don't want to give up any market. So okay, I can do these 3 verticals. I'm like, wow, you can't do 3 verticals well. You got to pick a vertical, knock it out, get growth, get predictability, get repeatability in the sales machine, and whether that's direct or channel. I think a lot of startups don't really think about channel selling. It's kind of like where you sell, let me go sell what I know. It's, you know, channels can be super effective. I've used them quite effectively, and some of my clients today use them effectively. And sometimes you need a direct selling, so you got to just kind of choose that. But yeah, you got to look at all those various growth factors, and then back to the M&A side. Sometimes you need to share with the acquirer, hey, you've got the resources for me to be able to go into that other market or go into this other vertical. I'm not there. That's all that listening to, hey, you've got 100 salespeople in the education vertical. We don't have anything there. You know, those 100 salespeople could do real damage with our product. But yeah, you have to kind of make some choices. But I always say, like, get one thing running as
and layer on the next channel, and layer on the next.
Yeah, and as Gordon said, you know, understand the unit economics of selling and how many. What does it cost to acquire a new customer? What does it cost to service them? How many customer service people do you need per customer? You know, what's the all that, you know, what is the implementation time frame? You need to know those economics in one vertical, and then kind of expand out of that. And I would be careful on early stage acquisitions when you're early stage too, because it's just, you know, 2 early stage companies together are just a disaster for, you know, just exploding into nothingness. You know? So I've seen that, you know, like, oh, look at that, we could come together, and like, you know, it's hard. So I think that, but I think you know, constantly testing those other growth vectors is important.
So I've sat on both sides. I've bought companies for Dell. I've been on the other side trying to sell something. Can you talk a little bit about selecting advisors, legal, financial, etc.? What types of advisors you should have, when you should keep them, when you should fire them? Speaking as someone who knocked down about half of an LOA price because we out-lawyered them, and and our tech guy, our code nerd was better than their code nerd by a lot. We got a much sweeter deal that was actually better for us, not necessarily for them, which is how the game works. And when the CEO figured it out, he asked me why that happened, and I said, you just didn't have the right people supporting you. So I'd love to understand like that part of it.
Yeah, one of the decisions is banker/broker, and then there's advisor. The banker/broker might come in if you've decided you need to sell the company, you need to run a formal process, for you to go out and knock on a bunch of doors or do it in a professional manner, et cetera. So let's call them kind of a scout. You know, they're going to kind of run a process for you. Many startups, it's a different situation. They find themselves at a cocktail party or at a conference or whatever. They meet a company, or it might be a customer of theirs, a partner of theirs, and this acquisition word comes up. Hey, now we're having a discussion. If you're already engaged in a discussion, unless you want to cast the net wider and hire somebody to go do that for you very quickly, which is not easy to do, you might not need the banker-broker type, because I'm sitting across the table from Dell and they've already said they want to acquire my company. You definitely need experts riding shotgun with you. At a minimum, it's an M&A specialist attorney, a badass ninja MF that's done it a lot of times, and you're going to pay them a lot of money, and they're going to earn it in a sack of gold, you know.
How do you do? But you had an attorney that set up your company.
No. Different attorney. Different. Your corporate attorney that helped you get onto Carta and do your cap table and set up your stock options plan is a different one than the one that negotiated the license deal with Dell and the distribution deal with Dell and all that stuff is a different attorney than the one that does an M&A transaction. It's a very specialized. Now, if you're in distress and it's a small little price tag and all you can afford, okay, you know, I've seen plenty of startups use their corporate attorney. Hey, I've done a few deals, but if you can afford it at all, yeah, you want that. You might also want, if you've never been through a transaction, an advisor. It's possible you have a board director. It's possible you have somebody on your advisory board that's been through it enough times. I was tapped and rode shotgun on the transaction for our portfolio company I told you sold earlier this year. It was a big enough number. They're like, Gordon, we just want you to just go along with us, and we want you to yell at us if we're doing dumb shit. Okay? And I even told the lawyers, because the lawyers are getting paid like $1,200, $1,500 an hour, the partners were. The lawyers aren't going to yell at the founders that often. We were in a meeting with the acquirer towards the end to try and iron out, like, we're going to lock ourselves in the room and get this deal done. The founders were talking too much. I was like, the lawyers are sitting right here. Do you see this army of people across from you? They're badass ninja motherfuckers, and they will eat you alive. They're asking you questions. They're watching the way you stop talking, okay? Let the lawyers answer the questions. Okay, I gave them the warning. After about 2 more meetings, they did it again. I told the lawyers, guys, I'm going to beat the crap out of these founders, okay? And they were like, well, are you sure? Yes. And they're like, yeah. They knew I should. We went in the room, and I just yelled at them. And they hugged me later, right? They knew I was on their side. The lawyers would not have done that. They knew me. I had rapport with them. I could yell at them in a way. So, yeah, I would think M&A attorney and probably some trusted advisor navigating through the process could be a good core team.
One other trick.
Yeah.
I refuse to have corp dev on my business card. I have business development. The second you say corp dev, the smart guys.
They know what that means.
Yeah. So just be careful when you're talking to anybody who's biz dev or anything like that. These companies, they're learning.
Yeah. So I know it's not black and white, but there seems to be a certain point at which, you know, bringing in a banker to run a process looks desperate versus when it just looks appropriate. Can you give some more guidance on that, assuming that you don't have somebody already teed up?
Yeah, look, I think that if running a process takes a lot of, it's quite a big distraction, and the right banker who can carry, who can actually, like one of the things like when you interview a banker and you want to interview a few, you know, like in the public company market, we call it the bake-off, right? So, you know, so you bake them off. I actually sat through a bake-off this week, so. And I think that you want to make sure they can carry the message well enough so that you as CEO or you know, or the team, management team, you don't have to do every meeting. And so they can expand the universe. They can also do quite a bit of work in terms of the synergies that you just don't have the time, et cetera. So I think obviously picking the right banker at the right time, and I think having banker relationships, we had banker relationships even though we never hired bankers. Like we had lots of bankers around us. We always met with bankers, got feedback. You know, they're just out there. They are talking to people every day, so they're a great source of information. But there are times, like some transactions, you don't need them, and you just have a really good deal lawyer who can really do a good job. But if you want to, also, you know, like one of the things that the bankers also do is they create a little bit of separation between, you know, relationship. You're going to get acquired, and you're going to end up being part of that other organization. There can be some pretty rough days of, you know, discussions and negotiation. Again, the banker can provide some of that, and so on. So I'm not I didn't say you have to hire a banker, but I think there are times where you do. But you certainly want to make sure that the bankers can understand your business well enough that they can have initial meetings, they can grow, you know, if you want to do a bigger process. Now, sometimes a big process is not a good idea because, like, we had a situation sometimes where you don't want your customers to know that you're in the process, you know.
Exactly.
That
Yeah.
creates a little bit of a situation. Sometimes it's a little bit, I think we think a little bit, we're a little too worried about that. But there are situations where you don't want that to get out, so you want to have a smaller group. But if, you know, like if you want to sell a business and you have something of high value, there's nothing like creating competitive pressure. You know, that's where you get the most bang for the buck, right? So, so I've seen both. You know, I had a young entrepreneur. He got a call one day from his first customer, lead customer, and they offered him an amazing M&A. I was like, we're doing that deal. Like, we don't need a banker. No one else is going to buy us at that price. Let's just go. So sometimes you just know that that's the right thing. But yeah, you know, if you want to run a process, it's hard to run a process on your own.
Oh, yeah, of course.
That's the way I would say it. I think if
Yeah.
you want to run a process, and again, it depends on the stage of the business. Like, in some stages, the board's going to say, well, we're just not comfortable unless you run a process. You do a market check or whatever. You know, those are like banking words, you know, market checks. But yeah, I would say that, you know, building up some relationships and using bankers as you know, input before you need them is a good idea. They do charge a lot.
Yes.
They do charge a lot. And there are bad bankers who just do nothing. So yes, I've seen that too.
But thanks for all the very good points both of you all brought up. One of the things that I hadn't heard was one of the problems startups have in terms of aligning their technology and their need with a large Fortune 500 is really understanding what the strategic direction is of the Fortune 500, which they have no clue at all, right? So you're kind of playing blind. You think your stuff is great because that's how you drive it, but it doesn't mean it has any alignment. In a previous one, we had actually got various people on our advisory board who were part of our acquisition. And so we kind of got the backstory and actually realigned the company, which drove. Can you give us any background on how you do that sometimes?
Well, sometimes our acquirers were partners of ours. And if they're partners of ours and we can see a window where either they might ask us to be acquired or we might try and pursue that, we would specifically try to gain some of those insights. You know, if it's a real strategic partnership, you probably have a dedicated person to that relationship. They're crawling the organization. They're maybe hopefully getting to know some executives. And yeah, what you're trying to find out is what are the CEO and the board members talking about? What's the CEO and their executive team talking about? What are the real strategies of the company? It's okay if the alignment is with top strategies of a business unit. It's business units plus corporate development that acquire companies, right? These big companies, they have multiple units. So it's best if you align with a strategy that is at the CEO level. The next best, and not too bad, is to align with a top 3, top 5 priority of a general manager, a senior vice president, general manager that owns a P&L. And yeah, you want to find this out. If it's a company you don't know, that you don't have this relationship with, well, if they're a public company, aren't they talking at conferences? Aren't they doing annual reports? Aren't they doing podcast interviews? Aren't they? And with AI, I'm just going to type that freaking prompt in and say, give me a 2-page summary, and I want to know everything that this senior VP and general manager has said for the last 2 years. It's not going to be that hard in this day and age. But yes, you do want to help them map to those big strategic priorities.
You said like after you sign like the term sheet, it's not the final part, and there's things that they could not like that your business is doing. But what are examples of things that they don't like, or examples of how that deal has changed or the outcome has changed as a result of that?
They might not like that you don't fully own all of the intellectual property that you're using. You didn't properly, do things like that. They might not like that you've granted stock options to a bunch of your early employees before you decided to get a real attorney, and you were using your Aunt Sally, and so you signed stock option grants that were not approved by the board of directors. You didn't have a stock option plan. You downloaded something from the internet. There's a lot of legal things in the early days that we're not intentionally trying to do things wrong. We just kind of don't know, and that's unfortunately not going to be. I wrote an article titled "Running a Clean Business," and actually no, the article's titled "Accumulated by the Book Debt Will Eventually Come Due," and it describes the categories of critical things you should never, ever, ever do. Your co-founder that you negotiated equity on just a verbal thing and you never papered up until later, and then they left the company, and it's still like they're yelling at you saying that they actually own 10% of the company even though they're not on the cap table. Yeah, that verbal conversation and that email and text message, they might have a copy of it. Like, there's a lot of stuff we do in the early days that can really be a problem. And so no startup needs to run 100% by the book, but you do need to run a clean business, clean enough that it's kind of like a baby step or just a regular step to getting by the book when you need to. And unfortunately, founders are told too often, just move fast and break things. Great. Do that with your hands on the keyboard with the software product that you're building just to fix. Don't do that in a lot of other aspects of your business. You might not even make it to kill the acquisition. It might kill your Series A, because guess what? Series A investors know to ask those questions too, right? There's a basic level of governance and things that you kind of need to do clean. Yeah.
I think the other thing I would say is that all these hygiene things which kill lots of deals is you've presented a forecast. The growth rates just don't seem to really, you can't justify it over time. Or, as Gordon laid out before, the process takes time, and you said you're going to deliver X revenue next month, and you were, 25% off. So, that'll kill deals too. So, obviously people are buying revenue, and they're buying, they're buying your, that's a big factor in many cases. And if you can't substantiate it. You said, we're growing 25%, but you're really growing at 10%. That's a big difference in the price. So I think those are some of the, but hygiene factors. And I was saying is almost every M&A I've done of small companies, we're buttoned up, and then they're not buttoned up. Where are your NDAs? I don't know where the NDAs are. Like, Okay, we need a list of every NDA you ever signed. Okay, we don't know where they are. And we got to go and search in inboxes and all this stuff. And this takes lawyers. Lawyers are charging by the
Even
hour.
basic board authorizations. You
Yeah,
think just because you're a C Corp and you're the only member of the board of directors that you don't actually have to have any paperwork for all these important decisions. No, there is a board consent for every important decision around raising money and granting this stock and things. And so, yeah, some founders trick themselves into thinking this is why, as soon as possible, getting some kind of corporate attorney, even if they're a freelancer that's just been around the block, and one of the first things they're going to do, they're going to go back to day zero and try and audit where are you and what do we need to clean up, would be, if any of you are having a freak out moment, just go find, it doesn't have to be $1,500 an hour, find a corporate attorney, help them, have them go back to day equals zero, and see what wasn't done. Because you can remedy, if you're only a year or two into this, you can remedy most of this. This is not catastrophic. It's catastrophic when you have a term sheet for a Series A and then they find it. It's catastrophic when your acquirer, they find it because you don't have time to fix it.
One more question.
The last one question? Okay, so.
In resume for myself, because I have a lot of questions, but a little bit like I can ask you later. Maybe I don't need it. You mentioned, Michael, that a startup on the early stage don't need to think about acquisition and exit and maybe more focus on models, but at the same time, you need to think about clean up your documentation and business and be ready to talk about that later, and have some minimum list, some triggers which you need to follow from the early stage, Yeah,
I think
because maybe the question, what the best time or right time, right trigger to start thinking about this exit, because some guys, if you see in LinkedIn, it's 5-time exit guys who just sell businesses and build them 1 or 2 years, and you understand that maybe this guy don't think about building the great company. They try to build the company to sell it in the first 2 years, and maybe it can work for him. But in general, what the maybe main trigger for that?
I think. Look, I think if you're thinking about strategy of saying, okay, I'm going to build a capability and I'm going to sell it early, then you're going to quickly try to find acquirers that fit the model. And a lot of people are really good at, hey, this industry, this ecosystem is lacking this one little piece. Let me go build something and sell it and then start again. And, they're good at that. And that's a model. I think so. And I would just say that I pick up on the other point that you asked is there's really not that much more expense to doing it right from the beginning. Putting all your NDAs in a folder and having a lawyer draft. It's just not that much work. It's just people being sloppy and not doing it properly and thinking they don't need to do it properly. Just spend a little bit more energy so that stuff is buttoned up, so that you can execute quickly. If you do need to, kind of move quickly, you've got it all figured out. And I think if your strategy is, hey, I don't want to build a huge business, then don't build a big business. I'm going to build some tech, and I'm going to look for someone who needs that piece of technology, and then I'm going to sell. It's a different strategy, for the business. And then you're probably trying to find the right acquirer from early stage. A lot of times what happens, you see this in industry that I'm familiar with, is people actually exit a big company and say, oh, I know what that guy needs. I'm going to go build it outside and sell it back to Gordon next year. That happens a lot. So a lot of those deals are done by folks that are already involved in the ecosystem. They're not people who are outside of it, because you know exactly that it's really hard to build this internally. There's no funding, the competency's not there. I can go outside, I can get it done faster without all the overheads and then sell it in. So that is definitely a model, but it's a different strategy.
Yeah, okay, thank you. Thank you, Michael. Gordon? Thank you. Please follow us, and I will be happy to see you
closer, please, because yeah. So, yeah. Comes around to the last one. People there, yeah. Oh, it's. Do you know? You should be some closer, please. Yeah, Michael, come here, please. Yeah, yeah. Okay, I will do the quarter. One moment, please. Smile. Smile. Smile again. Smile. And something funny. Let's do some. Oh, something like this. Show me some sales. Sales for company too. Thank you so much, and thank you to speakers. It was amazing. Thank you. OS, like operation system. Yeah, because we are talking about what's called system.
Oh, I got it.
Yeah. It's like, yeah. Originally from Ukraine. Yeah.
Every startup, everyone's like, someone's going to call you after disclosure statements. You're going to go sad. Slow down the deal by a month.
Володимир, ти ж не побачиш. Я хочу сказати, що задні двір,
It was amazing speaker. Yeah,
we play out, but it doesn't sound
у мене гараж задньому зараз. У мене є поєднані, але там можна поставити все, що він накритий стіном.
I love this. The option when you can talk with people which can inspire you. And like some huge stage or conference.
Huge. Там ком'юніті, там не трава.
Yeah. And we just have a lot of stuff. So we have a legal team, yeah, but I understand because it's one of the most things like here to yeah, but it's fine because in some days maybe it's I understand the guy working on my rest they don't have the same they just
and it's tough, you know, because yeah, it's not a lot of fun.
Yeah.
I mean, some people like it.
Yeah.
I mean, you have to follow the process.
I'm a big fan for finding the right people to do these. That's fine. That was my turn. Found the right people to do.
I can't stay focused that long. But I realize that what needs to happen. And then
yeah. How are you doing?
I'm sure.
Had to come out. Whatever, I gotta come out. That's good. Yeah. I gotta just tell them what it is. Excuse me, Gordon. All right, Val, I got to run, buddy. Yeah, same here. Yeah, enjoyed it. A lot of fun.
Yeah. Can I ask you a question?
Of course, yeah, what's up?
My name is Oliver. I'm one of the directors of the JP. One of my companies, I study dealing with special exploitation doing construction.
And I just love like practical. You know, it's like we're not gonna make it pretty. It's just like stuff that sometimes we just tend to run from.
I only saw it.
I just gotta do it. You gotta write stuff down. You gotta write. You gotta. Well, so we've been in a number of meetings out, and I remember, we're gonna get all this time. Someone asked for it, but it never seems to be the person in the meeting. It was someone else asked somebody, and we're not gonna pass on it. We're not too fast. The whole point is, like he's saying, like, it's gonna be a conversation.
Well, there you have the lawyer that you use for normal corporate matters, like you have someone over here.
Yes, for the contracts.
All the basics.
Yeah.
Usually,
Exactly.
those lawyers, they know they are the IT lawyers, they know the tax lawyers. So one of the best professionals here has to be existing lawyers. And then you have contracts and doesn't have to like the you have to refer from them with the ones that I'm thinking of, they're like 50 million larger.
And it's like,
But I'm hoping they all know other and the other thing is,
let me guess how this meeting went. Let me guess how this meeting went. Your boss is sitting next to you, investors over there, turns over the deck, and says, tell me about the assumptions you can't speak.
some people,
I don't want to hear from this guy.
I don't even, one of my first thoughts also was go find me 20 companies that I might want to acquire.
What are your options?
And we estimate all the funds because our clients are the best possible